Hey everyone, welcome to TechCrunch Live, where we help founders build better venture-backed businesses. I'm Matt Burns, and welcome to Austin. I'm very excited. We have a very special episode planned today, all centered around Austin, Texas. I hear the weather is lovely in Austin right now, but I'm in Michigan where it's cold and drab and there isn't a taco truck in sight. So this is City Spotlight in Austin. For today's special extended episode, we have a lineup of Austin-based companies and founders and investors who are here to talk about the region's challenges and growth and what makes it a city of unicorns right now. If you haven't already, I would check out TechCrunch.com. The site is crammed with features and stories and interviews of the Austin ecosystem. If you want to learn about Austin, today is the day. Here's a rundown for this extended episode. First up, we have a TechCrunch Live panel with Keith Melnick, CEO of the Zebra, an Austin-based tech company that moved to the city a few years ago and is one of the recent unicorns. Joining Keith is a longtime investor, Morgan Flagger. Morgan is one of the most active investors in the Austin area and an early investor in the Zebra. This is his town, and we're thrilled to have him on the show. We're going to talk through the Zebra's rise and what made Keith join or lead the company's Series B and then join as CEO. It's interesting because Keith is still kind of an outsider. He lives in Connecticut and commutes to Austin when he can. And I want to hear his perspective on the area and then also what it's like to lead a company by remote. Next, we'll have a panel from TechCrunch's Marianne on how to raise capital in Austin. Joining her are three active investors from Austin. If you need to raise cash, this is the panel you need to watch. Lastly, we'll have a pitch competition with three Austin-based companies that are competing for entrance into, and this is the first time we've announced this, but we've renamed a lot of things. And this company, the winner, will get fast-tracked into the TechCrunch Disrupt Battlefield 200, where they'll get free exhibition space at our Disrupt event this October. They're going to get 4 minutes to pitch their company with decks, and then they'll have 5 minutes to answer questions from judges. I have one more thing, and then we're gonna get into the episode. This show is streamed live on multiple platforms like YouTube, Facebook Live, and Twitter Spaces. But if you can, join us in Hopin. Hopin, the registration link should be in all three of those services. And if you can jump through the hoops to get in the Hopin, because there is a couple, you'll be able to talk to TechCrunch staff, ask questions, and participate in the pitch-off. So please do that if you can. So with that, I think it's time to bring on Morgan and Keith. Guys, well, welcome.
Thanks, Matt.
Yeah, so I understand we missed the day, the good day for recording this. Yesterday it was nearly 100 in Austin and everyone is inside with nothing to do. And today it's beautiful.
So, yeah, well, it'll be 100 every day here soon, but yeah, it is gorgeous right now.
But yeah, Matt, you already alluded to it. I'm in Connecticut, so I've got the same weather as you. It's cold and rainy here, so.
Yeah, one of these days we're going to be able to do this in person in Austin, hopefully next year. So Morgan, I wanted to start with you. I need you to put the Zebra in context for us. Where does it fit in within the Austin ecosystem and how does it work within it?
Yeah, good question. I moved to Austin from the Bay Area in 2006. And so I was investing here for a number of years before we made our initial investment in the Zebra in 2012. It was actually one of the first consumer internet or D2C consumer investments that we made. Austin kind of leading up to that point was primarily like an enterprise software and semiconductor town. And so I would frame it as kind of one of the pioneers in that area, not necessarily across the country, but in Austin. It was a typical investment for Silverton. So like our initial check into this business, I think was about $550,000 out of like a $1.5 million seed round. And then we went on to lead another seed extension and participate on the follow-on financings that the company has done. But what initially kind of attracted me and kind of led us to make our initial seed investment was just like the glaring market opportunity that the company had. And I know we're going to go through the deck and we can get into it, but disrupting the $166 billion auto insurance industry and doing it in a way that makes the buying experience better for consumers was definitely something I was interested in getting behind. And luckily for me, Keith and company have done a great job executing on that vision.
Yeah, I want to stay with you a little bit more. I hear the Zebra was convinced to move to Austin. Is that still happening? Or are you still writing checks to people on the coast and convincing them to come to Austin?
Yeah, it is still happening. That convincing has gotten a little bit easier in the past like 2 or 3 years than it was back in 2012. But yeah, the company was Pittsburgh based. It was actually part of a Carnegie Mellon accelerator called Alpha Lab. Convinced them that Austin was the right spot to build a business. We were the right partner to kind of help, get the company off the ground. And it was actually one of I think 3 East Coast based companies that I relocated, to Austin in kind of the 2010 to 2013 period. That continues.
Yeah. Can you think of any recent people that moved there?
It depends on kind of how recent is recent, but some of our bigger successes, we're an investor in a company called Self Financial here in town that actually initially moved down here for a Techstars program. They're originally from Colorado, and then they've stayed. We actually relocated a company, from Dallas, which, isn't out of state, called Fetch, that we made an investment in. That was just a few years ago. Lots of relocations. I think when we last did the math, I think in total, we'd relocated 9 businesses to Austin.
Yeah, that's great. And then Keith, kind of the same question for you. You're not a founder of the Zebra, but you joined as the CEO after leading the Series B. What brought you to the company?
So I prior to the Zebra, I helped start Kayak. So I was at Kayak for 14 years, which is the reason I'm in Connecticut. I guess we didn't go look to raise money from Silverton, so we didn't get asked to move to Austin at the time. But one of our investors in Kayak was Silverton Partners, actually led out of their office in London. And when I was thinking about, after 14 years, thinking maybe I got one more in me, looking for something else to do, one of the partners from Excel, a guy named John Locke, came to me and said, "Hey, I'm looking at this company in Austin, calls themselves the Kayak of auto insurance. Would I go take a look at it?" More from an investment perspective than running the company. They'd asked me to look at a few things for them in the past, primarily in travel. So I went down, met the guys from the Zebra. I knew nothing about insurance at the time. I knew travel and I knew search, but I didn't know insurance. Got educated in the market. And actually some of the things Morgan mentioned about the reason that he decided to do that initial investment were the same things that I quickly realized. It's a gigantic market. I estimated at the time that I think the distribution market for insurance was about 8 to 10 times the size of the opportunity we saw when we started Kayak and travel. Huge amounts of consumer dissatisfaction, which I don't think surprises anybody who's shopped for insurance to see that. Highly fragmented market. I was actually surprised by that as an uneducated insurance shopper. I just assumed there were 6 or 8 large insurance companies that you see ads for, where there's actually well over 400. And nobody had actually built a product in the market that actually met the consumer needs. So I went back to Excel and said, "Hey, I think this makes a lot of sense. There's a huge market opportunity, plenty of runway here. There's just some things executionally that I think should be done differently." They came back and said, "We'd love to make the investment, but would you be interested in going along and running the company?" I, of course, said, "There's no way I'm going to go do this if the current founders don't want me to be a part of it." So after having conversations with them and with Morgan, they made me the proverbial offer I couldn't refuse, both in terms of the opportunity that was there and just the ability to go and kind of build the company that I always wanted to build. So that's why I decided to sign on. Also, it should be noted, I invested at the same time too. So I'm not just a CEO. I put my money in there, so I've got skin in the game as well, which is why some of the stuff Morgan talked about, I saw the same opportunities there.
Yeah. So you invested in the Series B, right?
Correct, and the Series C. Yeah.
And then I'm sorry, what did you say?
I said, and also the Series C, I invested there. I guess the good news is when we went out and did our last round, the Series D, we got priced out of my my investment range. So.
Yeah. Well, I guess you need an exit here to knock up to the next one. So what advice would you have for companies that are looking to bring on external leadership like yourself?
I mean, I think the thing that really made this work really well was having founders at the company who didn't feel threatened. It wasn't that Morgan and the existing board and the existing investors said, "You guys aren't capable of doing this." I like to still believe I'm young, but I definitely have a few rings around the tree here. And I view business as really good business as nothing more than pattern recognition. And you see this stuff over and over again. And I just had more experience, and I've seen a lot of the patterns and a lot of the stuff that they were going to experience. And they were relatively young, hadn't seen as much. So the fact that they were really open and said, hey, we want you to be a part of this and work collaboratively, not threaten that I was going to come in and run the company that they founded, is really what made this all work, coming in as an external CEO and actually not being a founder of the company.
Yeah. Well, how apt is that comparison? Is Zebra really the kayak of insurance?
I'm going to slip into travel analogies. So at some point, cut me off. I think when I first came into the company, I think the notion, and I know we'll go through the pitch deck. The interesting thing is there's another version of this pitch deck, which we actually eventually used to take to Excel in the existing investors, but it's a version kind of down the road. So I didn't write this one, which is actually really interesting for me to look at. I think some of the stuff in here, I guess it's typical of a lot of pitch decks, is probably a little bit more aspirational than where the company was at the time. So I think the company aspirationally wanted to be the kayak of insurance in terms of performing that kind of meta search or that true search experience. So the shorter answer on that is, when I joined the company, no, it wasn't the kayak of insurance then. I think we got it to be more of the kayak insurance, but as our business models evolved, if I think about what kayak does, is they help people find things and then send them off to, whether it's the airlines or the hotel websites, to buy it. We're transitioning more to be like the booking.com of insurance, where we're actually performing more and more of those transactions and facilitating it. I still don't want to underwrite insurance policies, just like Booking doesn't own the hotels. But the more that I can actually own that relationship with the consumer and facilitate the transactions. And so that's where we're going now, and that's where we are.
Well, let's pull up the pitch deck right now. I don't think that's on you, Keith. That's on my end. Yeah, great. So before we get into it, Morgan, I want to ask you that similar question, though, right? What advice do you have for people that need to bring in external leadership?
Yeah, I think it's the relationship with the folks that are coming in that's the key thing, and having that be in a good, healthy spot where it's not something that's forced on them and they're excited about the opportunity to learn. So, as a founder, you can view, a change that's made kind of at the CEO level, like one of two ways, right? It can either be, hey, I'm not cutting it and I'm getting replaced and it's a negative thing, or you can view it, especially if you're a younger founder, as, hey, I'm going to have, 3 or 4 more bites at starting companies if I want. If I can learn from someone who's, built a multi-billion-dollar company, taking it public in a very analogous industry, that's a heck of an opportunity to kind of ride co-pilot, so that the next time you kind of, come out with a new business, it's better, faster, stronger. And then obviously you get the opportunity to build relationships with the other managers and investors that come along with a very successful company. So it's kind of an amazing opportunity if you embrace it, but I think you kind of have to be in a spot where you're ready to embrace it. And then the other piece is, really purely economic with that opportunity itself, which is, with the case of the Zebra, we always knew that the true aspiration for the company was, a potentially public, $10 billion plus asset, right? And it's also a marketplace. So sometimes with marketplaces, you have to raise a significant amount of capital. You kind of have to get the marketplace built and the flywheel going before the business turns and is profitable. And so you need someone who can go out to a pretty sophisticated later stage investor set, tell the story, raise that capital in order to realize the full investment potential of the business. And so if you're just thinking purely from your pocketbook and not beyond that opportunity, but just on the opportunity, owning, a pretty awesome piece of the pie because you built it and started it and still own a good chunk of it, and then maximizing that outcome with an amazing, CEO or management team, is really in your best interest. But, again, I think that you kind of need to be in the right frame of mind to accept that.
Yeah, thanks.
Definitely, you have to put your ego at the door for sure. But, if you're willing to learn from the old man, I think it helps.
Yeah, I think the key takeaway there is there's going to be a next time. You both talked about your second act and moving on to the next time. And if you learn, it's available. So let's get into the pitch deck real quick. And this is the first time, Keith, that we've had somebody present a pitch deck that did not write it. So it's a little different for me.
Yeah.
And so I was hoping you could put your investor hat back on and take us through the pitch deck from an investor's point of view, what works and what doesn't work. And Morgan, you can chime in too.
Yeah, I was going to say Morgan may have this too. Before we jump there, and maybe this is one of the things you're looking for later on, I will say, after having been through this pitch experience so many times, and I think that's one of the things that also entrepreneurs need to realize is you are going to get told no so many times. And you just need to get used to that. And when I was halfway through our Series C, I said to one of our existing investors, kind of had the realization that you can say no to every single deal that comes across your desk. Nothing is perfect. And while this pitch deck portrays the company as being perfect, you always want that. If you dig hard enough, you know nothing's ever perfect here. And asked him how he actually makes the decision on what he's going to invest in. And he said, well, the answer to that's actually relatively easy. It's all about the people. No matter what you're trying to get from point A to point B, it's never a straight line. If you've done this enough, we all know that it's about making sure you identify the people that can actually help navigate that path, that it never is a straight line. And the reason I bring that up when we talk about kind of the quality of this pitch deck or what's in the pitch deck, and I think it's actually interesting for me to go through and honestly look at this with a fresh set of eyes, is there's certain things in here that are fluff and puffery, but it's all about that conversation and giving that investor the feeling that you know how you're going to be able to handle and are going to be capable of handling when things start to go a little sideways, because they always will.
That's great insight. Thank you. So why don't you take it away, take us through a first few slides, and we'll pause after that.
Yeah, the first slide in this is the same first slide I think, Morgan, you've probably seen every single pitch deck, which is just kind of the highlight key facts. And I think the stuff on the right is really the most relevant thing. So showing what you're projecting in terms of the revenue growth and where you've been, and keeping in mind that there is some traction going on in the company and some momentum. So especially at this phase at a Series B, at this point of the company, you're kind of figured out what you're doing and it's starting to work. And it's that next phase in terms of how do we lean in and really grow that. And that's exactly what this slide demonstrates here is, okay, this was 2017, I think, was at least when I came in. So this pitch deck was probably written late 2016. So you can see there was some momentum coming in and a projection of that continuing to go on.
Yeah, I mean, the only thing, that I'd kind of add here, just as an investor who's done a bunch of marketplace businesses, is the hardest thing is like getting the company off the ground that's a marketplace business, because there's always this chicken and egg problem. And so for the Zebra, the chicken and egg problem was, in order to create the consumer experience we wanted, we needed a bunch of carriers to sign up and pay us for the traffic we were generating. And the carriers didn't really want to sign up until we had a bunch of consumers that we could offer to them where they can monetize them, obviously through selling them policies, right? And so the company had like a really unique way of kind of faking it until they made it, I guess, in the early days, which was really before this particular slide. But what they did was they used machine learning and AI to kind of reverse engineer what a carrier might price a policy at, based on their state filings and a bunch of other data and profile data about the consumer. So they could show a pretty robust search set to consumers long before they had deep integrations like they do now with carriers for like very specific pricing. And so that allowed them, you see kind of the revenue growth here to kind of get the flywheel going a little bit. And so for investors that see a marketplace business that's kind of gotten off the ground and started to turn over, that's usually a really positive sign, because that 0 to 1 moment is usually where, 80% of, marketplace companies tend to fail.
There's plenty of faking it before we made it in this pitch deck still. So
let's go to the next slide.
So now we're setting up the size of the prize or the addressable market here. One of the things, and maybe I don't know if this commentary is helpful, is this is specifically one of the things that I changed in the pitch deck when I came in and we kind of wrote it when we went out and actually did the investment. But I had the benefit of the comparison I talked about showing to relative to the travel market. But really trying to put some perspective around the 271 billion is a huge number. It's an enormous market. And the version that we adjusted to showed the size of the travel market relative. Like I said, it was about 8 times smaller. And then the valuation we were able to pull out of Kayak doing this. So just putting it in perspective for an investor of what the potential size of the prize is here in the market.
No, that's good context, because it's about providing context to the investors, right? Because you need to assume that they know something about the market. But
I mean, Morgan, as a good VC, Morgan will never admit that he doesn't know something, but it's probably helpful to give him some education in terms of like what the size of the prize really is here. And I find over and over, when you are talking to VC, rightfully so, they go back to what they know, which is other companies they've invested in or other companies that are out in the public space or have been written about. And the closer you can draw those analogies between what you're trying to do as a founder or as a CEO versus other things that exist in the market that you want to be good analogies, put those analogies out there. That helps them go, oh, I get it.
Great. Let's go to the next slide.
And it's a great flip from going to what's going on and kind of the size of the market to how you're actually going to address the market. And starting to talk about, I mean, there are some wonderful buzzwords in here, the IoT, big data, AI. You got to throw those in, just so the investors latch onto them. But really continuing to get to why, great, it's a big market, but so what? Why is it worth even starting to play in there?
I think some of what you're seeing here is we've seen other models who are more like vertically integrated full stack carriers like, Lemonade, et cetera, right? Who have, there's a bunch of opportunities within insurance, like the Zebra's chosen to attack the distribution side of it versus like better underwriting models and using EI to like better gauge consumer risk and offer different pricing. But the Zebra is also the enabler of those new models to reach consumers, right? So, Geico and Progressive and all the other insurers are going to spend a ton of money. They're going to attract, lots of visitors. The Zebra is going to sell those policies. And then the Zebra is also going to sell the policies of the new guys right alongside those. So you can kind of create a one destination site where people can be educated, and have exposure to some of the new models alongside, the kind of known and trusted names, which is kind of a unique position. And obviously, like, we haven't chosen to do that directly, but rather just kind of enable those other players through our distribution strategy.
Which is actually a wonderful setup for the next slide. Sorry, I'm taking over the slide control for you. But this really then is the continuation of the slide before and what Morgan's talking about, because this is where we play in the value chain. I just have issues with the word meta search and meaningfulness on anyway, but this really gives the demonstration of we're not trying to underwrite insurance and not trying to play in that part of the value chain. We're playing in the distribution part and doing it as a meta search engine. So it's kind of similar to Morgan's point, InsurTech, fintech, InsurTech in particular, such a big thing. It has been for a while in terms of investment, but most of the big splashy stuff, a couple of years ago was around full stack carriers and playing on that underwriting side of the business. Here, we're making it clear where we're playing in the business and why.
Next slide.
I mean, you got to say you're the best at something. You're out there getting money. So, in InsurTech, there's a little creativity in terms of the definition of InsurTech. And this, I guess, this was also written 5 years ago. So a little bit changing. We are still, we are by far the #1 most visited comparison site for insurance. So I think when you're writing a pitch deck, you kind of what Morgan had talked about earlier in terms of building a marketplace. And at this stage, as the Series B, proving the flywheel is already going already. This is a continuation of that as well.
Yeah, let's pause here for a second. Morgan, when you see a slide like that, would you audit that or verify that claim?
Yeah, in that case, it depends on what the claim, is and how easy it is to verify it. But, obviously like Alexa, there's a bunch of sites out there where you can go look up traffic stats and history data and compare them to other sites. And so, yeah, absolutely, right? If it's a traffic question, we have access to those data sites, and we're going to go verify that that's true.
This is one in hindsight, writing pitch decks after this and all that. I prefer to put that data right there and demonstrate, again, giving that comparison, saying we're not the number one visited site. Here's where we are. Here are the other ones that we're sitting above, so that Morgan doesn't have to do that work as an investor. He can see right there that, like, oh God, these guys are bigger than Compare.com and Surefire, any of the other potential sites out there and what we're talking about.
Would you put that right in the slide or put it in an appendix?
I would actually put it in the slide. I mean, you don't, the other thing is I don't want to make Morgan have to go and do that work. I'm trying to get him intrigued and go, okay, this is an interesting company. And then I got to get him to start to do his diligence and then want to dig in. You've probably got what, 300 of these sitting on your desk right now. Why would I give him a reason to go, I don't have the time to look at this?
Yeah, as an entrepreneur, I mean, I think when you create something, you have the opportunity to choose the data source, right? So if there is a particular view on the data, like traffic's pretty objective, but even within traffic, there are some different numbers depending on who you ask. So if there's one that you think tells your story the best and you present that, you're going to be in a better spot. Because if I go and use something else and it doesn't quite show you in the greatest light, which I'm going to do, as we just talked about. Whereas if it's presented right there, maybe there's a chance I say, okay, well, I trust, that data and I don't need to kind of do more work. So I think you're always kind of benefited to choose your source.
We have time for 2 or 3 more slides.
So this one is a great concept. It's fun. I feel like I'm back. I was a consultant before I helped start Kayak. I feel like I'm back in my BCG days, giving feedback on a slide deck from one of the consultants that gave it to me. The point of this slide is actually still relevant. And there was a slide, almost the exact same title in our Series D, setting up what goes on in the rest of the market. I think the mistake that was made actually writing this slide at the time is now I'm starting to assume, and I'll use Morgan as the example, particularly if he's a new investor, that he knows what the hell I'm talking about when I talk about lead gen players or a regional insurance agent and what that arbitrage model looks like and what they're doing. There is a new version of the slide that we used in our Series D deck. I think that just does a much better job of explaining how that lead gen works and why it's horrible for a consumer and the limitations that the regional insurance carriers have in terms of the content and why that shorts the consumer experience also. So point of the slide is spot on. I think, again, it gets to that. We're making the potential investor work a little bit too hard to understand what we're talking about here.
Great. Next slide.
You got to get to how it works. So I think now we're starting to get into the underlying technology. And I know we're not going to go through all the slides. What we start to set up here, and it's a little on the next slide, but I prefer even to do a little bit of the product demo to talk about how this works and how we're actually going to deliver. So as a pitch deck, we've set up, here's the size of the opportunity, the size of the prize. Here's what consumers want. Here's what the competitors are doing. Now we're starting to talk about how we're addressing the problem. And so you see, you get there, you get a little bit of the screenshots, but I think a little bit of a better demonstration again on how this all works. I mean, invariably, Morgan will of course go use the product before he decides to make this investment. Almost kind of to his point too, product demos, live product demos are always a roll of the dice, especially at this stage of the company back to Series B. I would want to say this is the way ideally the experience works. So if he gets a different experience, then there's some explanation of, okay, here's the limiting, here's what we're working on and here's changing. Nobody expects things to be perfect, but I want to put that perfect example in front of him.
Yeah, and like what's implied here and maybe not said is, the Zebra always took the optionality on focusing on the consumer first versus necessarily focusing on the carrier. And the thought was, hey, you're going to win consumer loyalty if you include more carriers, because more choices equals, probably better pricing or better decision set for the consumer. If they're finding things on your site that aren't on other sites, that again is going to be a checkbox in favor of the company. And so what the company didn't do was, have a more full featured, potentially site, but only have it with like 2 or 3 carriers, or only show the options where it monetizes the best it was really centered on like creating the better consumer experience, because we knew that if we had the consumers, that the carriers would come, and eventually like the monetization would come. And so this is part of the thing of like, hey, more carriers than anybody else, we're going to include everybody, it's going to be an omni-channel model, and we're going to kind of really speak to the pain point in the consumer.
Let's talk about demos here real quick. In this age of Zoom and COVID and everything, excuse me, what's the best way to do a demo?
Well, when we've done demos, either for investor meetings, kind of the Series D that we all did Zoom, is you just want to go through and say, okay, like it's like anything else, you want to practice it. You want to be very clear in terms of these are the, if for us, it's a market you search in, our content would be different if you're searching for an insurance policy in Minneapolis or in Detroit, for example, because Michigan has some arcane insurance laws versus Texas, where we have a broader coverage and things are very different. So I'm going to want to make sure that I go through and first do the demo in Texas. I'm going to want to make sure that like, here are the consumer factors, and go through and practice it and make sure everything is exactly what I want to demonstrate and point out.
Would you pre-record it or use stock footage, or does that have to be live?
I don't like to do that, because then it feels like you're starting to play games with stuff like that. So I'd prefer to do it live with some practice. And I mean, after having done this now for almost 20 years, and I'm sure Morgan sees, like, sure, things won't go right. There's nothing wrong with going, oh, well, that's not the way it's supposed to work. But we can get that fixed and then, being open about that stuff.
Yeah, I mean, I think the one advice that I would give, having seen a ton of demos, is like I'd make your canned part of it, and canned doesn't necessarily mean pre-recorded, but the part that the segments of the product you're going to go through, like pretty short, like certainly less than 10 minutes and probably more around like 4 or 5 minutes, and then let the audience or the VC or whomever kind of probe in and ask about stuff, because sometimes you get caught up and you feel like, hey, I need, our engineers spent all this time developing these features, and I need to go through like every single one in order to like show how deep the product is. And, sometimes I can just take away from the time you have to kind of tell the other more compelling parts of the story. I will tell you that if there is like a homework or takeaway experience that you can give the investor as well, like, hey, go like, here are 3 or 4 other options to solve this problem. Like, you should go check those out on your own time and just see what the experience is like. Like that can be powerful, especially if you've done a good enough job hooking the investor in the pitch to make them want to follow up. Like in this case, there wasn't a comparison site when we did this in 2012. And so you literally had to go either, to 10 carriers directly, plug in the same information 10 different times to get pricing, or you had to go to like a lead gen site and like put your information, the contact information in a form. And literally, like I did that just to like go to the leading lead gen sites and see what that was about. And I literally got spammed and cell phone calls for like multiple weeks. And like to some extent, it kind of brings it home, because you're like, oh yeah, like the existing experience really does suck, as much as you like say it does, and you're not just kind of overstating it for the point of making your product sound better.
And that's a wonderful point Morgan brings up. So if you can get that reality for the potential investor in terms of what the consumer problem is, because you can't make the assumption that Morgan's gone through and shopped for auto insurance in the last month, so he understands that, like, wow, this is really a pain. My favorite story of that is, and I won't mention the investor, when we were pitching Kayak, we went to one VC and presented all of this, and there was silence. And one of the investors said, well, none of us fly commercial. So they had no idea kind of what the issue was shopping for commercial airfare.
Right. Well, I don't know what the issue is in searching for private airfare. So
yeah, exactly. So we didn't solve that problem yet.
Yeah, great. Well, we need to close this soon. I have 2 questions left. One, why is it the Zebra and not just Zebra?
It was affordable and available. Zebra.com is owned by a large technology company. It's actually a public company. Which is not too dissimilar. Also, part of the reason Kayak was because it was affordable. So there's something to be said for when you first start a company and you have limited funds to actually getting a URL that's affordable. And look, at the end of the day, any name or anything like that is an empty vessel. That as you build a company, you think about what you're going to create around that. So it kind of doesn't matter.
Yeah, I remember back in 2012 when like the name discussions were, actually happening. And I think someone had this idea of like, basically like your insurance coverage in black and white, just like making it, easy and, to see the different options and having it right there. And so once that happened, then the creative process started and we ended up where we ended up. Yeah.
Well, it's good enough. I like it a lot. So Morgan, last question goes to you, and you're a big time investor there in Austin. I got to talk to you about Austin real quick. What are you investing in right now?
Yeah, so I'm spending, I guess at the very highest level, like we tend to be generalists. So we don't have, like a vertical model where like I only do, IoT or, enterprise software or whatever. But where I'm spending most of my time is in health tech right now. And there's a bunch of different opportunities and we have some, pretty successful investments in that area, as well. But like, in my view, like the pandemic with telehealth accelerated a bunch of characteristics of that market. Obviously, like the healthcare market itself is ginormous, similar to the, obviously even bigger than the auto insurance market, but it's just a wide open playing field. And it really does need to get fixed, right? Like healthcare premiums can't continue to rise at the way they are now. We need to, make care more accessible, more affordable. We need to use AI to make better decisions within healthcare. The way that the insurance model is deployed right now needs to be fixed in several ways. So there's a bunch of different avenues within that broader landscape that I think are intriguing. So I'm spending a ton of time there. Fintech and SureTech is somewhere I always spend a bunch of time. And then within enterprise software, like identity management and security has been an area that I've spent a bunch of time. And so doing that as well. And then, as a firm, we're also spending some time in Web3, and we do have one of our partners, Kit McClanahan, that's kind of leading the effort there. And Austin is an interesting spot for really all these verticals that I was just describing.
What's the best way to pitch your firm?
The best way, we're pretty prolific investors within Texas. And so if you have a relationship to an entrepreneur, that we've backed or someone that knows us, like that's the best entree in, is just have them refer you. If you don't have that relationship, like, all the partners like do check email. We do look at pitches. We do have a junior set of folks that will like pass stuff off on. And then I'd say, don't just send one email, like if you get a response and it's a pass or you don't get a response, like continue to follow up with like, I'd say tangible, like monthly or quarterly, like investor updates with metrics. Cause sometimes the thought might be, hey, it's just a little too early, or there's not enough traction, or I want to see how this one element of the story develops. And then in one of those updates, like I may read, hey, they've solved this problem, or, the momentum is starting to build here, and just kind of proactively reach out to the company. So I would say probably like a third of investment opportunities we pursue are like long burn, where it's like, hey, we didn't engage initially. It kind of went into this like high quality monitor, like hold state, and then something happened that had us pick it up again. And so just be persistent.
Yeah,
I may have misheard, but I think Morgan's first point was he said they should pitch me first before him. And if you want his phone number, I can give that to you. So,
Keith, Morgan, it's been a pleasure. Thank you for joining us, and thank you for helping us shine a spotlight on Austin. It's been a real pleasure.
Thanks for the invite. I appreciate it, Matt.
Yeah, and everyone on the stream, please stick around. Up next, we have Marianne with she's the host of our equity podcast, and she has 3 active investors in the Austin ecosystem that are going to tell how to pitch them and what the best practice is, and how to get their cash. So stick around. Thank you, everyone.
Thanks.
Hi, everyone. I'm so excited to be here today and really appreciate you joining. You're going to hear from 3 awesome early stage investors here in the Austin area. Sarah Brand, who is founding general partner of True Wealth Ventures, Brian Chambers, who's president and co-founder of Capital Factory, and Krishna Srinivasan, who is a founding partner at Live Oak Ventures. Hi, everyone. Thanks again for being here.
Good to be here.
Yeah, so I think we can all agree that the startup scene here is unlike it has probably ever been. There's more startups than ever, more investors than ever. So that also, I think that means there's a lot more capital than ever, but there's a lot of founders vying for your attention. So I'd love to hear from each of you what your investment strategies are. And then what probably a lot of founders want to know, how can they get in front of you? What is the best way to get your attention? But first, why don't we start with investment strategies? Sarah, can you share what yours is?
Sure. We have a pretty explicit investment strategy. We invest exclusively in women-led companies, and we define that as at least one full-time woman is on that founding or early stage C-suite. So it doesn't have to necessarily be the woman as the CEO or all women. And we invest at the seed stage. That varies quite a bit these days, but our first checks will be up to like $1 million as we like to lead, usually take a board seat to give you kind of a feel for the size of the round. We invest across the United States. So me and my partner, Carrie Rupp, are both based here in Austin, but we invest across the US, literally from Maine to Southern California. And we invest exclusively in the markets of environmental or human health. So those women-led seed stage companies have to be really focused on moving the needle on improving either environmental or human health.
Okay, so quite kind of, I would say, a very specific set of criteria that you consider when evaluating investments, it sounds like. Can you name some of your previous investments or some of the companies in your portfolio?
Sure. I can name maybe 3 in Texas from Fund 1 portfolio. We're investing out of a second fund now, but Unaliware was our first investment out of Fund 1 based in Austin. They're making a smartwatch for seniors for fall detection, guarding against wandering, medication reminders, etc. We have a company that's headquartered in Houston that actually has an Austin office as well called BrainCheck. They do cognitive diagnosis or cognitive assessments, and then cognitive care plans, etc. And then we have a Dallas-based company called Rosie that's a sexual wellness for women founded by an OBGYN.
That's really interesting. And I think I've written about those first 2 in the past. So I remember their names. Brian, I would love to hear from you. I know Capital Factory is considered probably a very early stage investor because you're also an accelerator. Can you share with our audience who may not be familiar with what Capital Factory is exactly, what you all do? I know it's more than just investing. You have office space, and what your investment strategy is.
Yeah, thank you. We're definitely a unique organization. Capital Factory was started in 2009, so over a decade ago in Austin, Texas, and really by a group of friends writing a bunch of angel checks and getting together, writing angel checks and wanting to do more and help the startups that we were investing in. Today, Capital Factory's really become a true center of gravity for startups all across Texas, and we are relentless about helping them by introducing them to their next investors, their next customers, the talent that they need to scale. I always call those the 3 universal truths of every startup: money, customers, and talent. And then also the silent 4th, there's always specific problems that startups have along the way, and we like to lean in and help on those specific problems as well. You are right, we do a bunch of different things at Capital Factory. We're a pretty big organization, about to eclipse the 100 FTE mark again. And we have office space all across Texas. We published a particular investing thesis and expanded across Texas, our footprint from local to Austin to all across Texas, and a Texas-wide, Texas-based organization, really recognizing that in 2016 that Texas was very unique regionally and geographically unique, with 5 of the top 12, now I think 5 of the top 12 largest cities in the country between Fort Worth, Austin, Dallas, Houston, and San Antonio. Anytime somebody makes a list, it seems like those are all on the fastest growing cities as well. So the largest, fastest growing, Texas is if it were a country, I think it's maybe the 9th largest economy in the world by GDP. And so we recognized that there was a kind of an underrepresented share of early stage venture capital that was coming to Texas. And yet all the facts that I just mentioned are the leading indicators of what should be and will be coming to Texas. So recognizing these, we put a specific investing thesis and a plan in place to expand all across Texas, establish kind of boots on the ground venture team members across all of Texas, and build a network across Texas to capture a lot of the early stage deal flow. So it's true, we advise startups, we invest into startups, we advise corporations like Microsoft and Amazon and Deloitte and IBM, and the Army and the Air Force as well, about working with startups. We're running today where we run and manage the Texas Fund. The Texas Fund is a rolling fund on AngelList, and we're known for being one of the most active early stage investor in Texas. We're not the biggest fund and we don't write the biggest checks, but we are the most active. We write a check or two a week, so we're very busy. And we're constantly we're a follow-on investor. There are some exceptions to that. In the event that we previously invested in a founder and had some great success with them, we'll take a little bit more risk getting in a little bit earlier. But as a follow-on investor in what we like to say institutionally priced rounds or institutionally led rounds at the seed, Series A, and now even the Series B level, we write checks between 25 to 250, sometimes a little bit more in Texas-based companies that have a lead investor. Like True Wealth or like Live Oak, we co-invest with both a whole lot. And our job frequently is working together with them to run out and find these companies and make a bunch of curated introductions to them. And when Krishna or Sarah say, "Oh God, we're going to write a check, we want to invest in this company," that's a strong signal to us as well. And we like to participate and follow on and help those portfolio companies that we co-invest in with all the VCs across Texas.
Okay. That's helpful. I didn't even know all that. So I appreciate the information. Krishna, so Live Oak, you raised a $210 million fund last year. Can you tell us a little bit about, I know Capital Factory is focused on Texas only. True Wealth is not. What about Live Oak?
Well, very much the case. We do have a very explicit strategy here, and it comes out of 22 years of doing the business kind of the same way, which the investment strategy has been identical over the period. And for that, as you said, we are investing out of our third fund, which is $210 million fund, and Live Oak has been around for a decade. Strategy for us is all our companies are founders who are based in Texas. So with center of gravity here in Texas is a must-have for us. Number two is these are all tech and tech-enabled services businesses. So tech that intersects with just a wide variety of segments, so multi-segment in nature. In these, we are co-leading investments in these. Typically, they are first institutional money, but sometimes we make exceptions. But predominantly first institutional money sort of investing in these companies. And lastly, we play an active role, almost always take board seats in these companies and are active investors for the whole life cycle of the business from the point of inception or our first investment through the whole life cycle of the business. We invest anything from $1 million sort of first check to $10 million sort of first check, and then expect to follow on through multiple rounds of financing from those early days to ultimately through promised land. So the companies, therefore, are obviously in all kinds of segments, tech intersecting legal, compliance, prop tech, and logistics, healthcare, any segment where there are exceptional spikes in Texas and cybersecurity, enterprise infrastructure, a pretty wide gamut and intentionally multi-segment in nature because we are fundamentally very entrepreneur-driven as opposed to segment-driven in terms of our investment approach.
Actually, that was one of my next questions for you. I know one of your portfolio companies, Disco, went public last year, right through IPO, and I think was valued at, remind me, $2 billion. Is that right? Yeah.
Exactly.
Okay. So, so you kind of mentioned you're looking at a gamut of industries. Is there anything in particular that has, and I'm curious, this is a question for all of you. Is there any particular sector or industry that has you particularly excited right now?
Like I said, we are very much people-driven, entrepreneur-driven. When Disco was formed along with our first check for $2 million, and we were obviously active investors from then to IPO. We now have an incredible prop tech portfolio, companies in the intersection of real estate tech and fintech. I know you write a lot about that, Marianne. Companies like, Ojo, Opsity, Homeward, and so on. So I think for us, the investments end up being wherever you get world-class strengths in Texas. Our investment approach is, can you back category leaders coming out of Texas? And these end up being in areas where you've got.
Thank you for, yeah, dropped. Okay, well, hopefully he'll be back on. So as we wait for Krishna, Sarah, you already, oh wait, he's back. Oh, you're back.
Did you lose me?
We did, we lost you for a minute. So glad that was short. Okay, please go ahead.
Sorry, I'm at UT, I just spoke here, and sorry about that. I'm a guest in the. So I was saying, intersection of technology meets a wide variety of industries. As I said, real estate, logistics, healthcare, all spectacular industries where we see tremendous amount of strong activity in this market.
Yeah, there is a lot going on. And Sarah, I know you touched on earlier some of the industries in particular that you're looking at, but even within those categories, is there something in particular that has you all excited or that you're really actively looking for investments in?
Well, I would say, we're kind of looking at these areas where women have an outsized influence in terms of, purchasing the technology or products, and being aware of, what's available and what is not available to solve critical environmental and human health issues. So we've seen that, femtech as a term got coined right when we closed our first fund. So it's not new, but it's lots of new stuff there. Silver tech is an area that we've actually invested quite a lot in. That wasn't part of our thesis, but we see that daughters and daughters-in-law are the largest form of healthcare, for aging parents and parents-in-law. So a lot of women are creating solutions in those spaces in particular that have just been so underfunded by the VC community to date. So lots of opportunities there. Menopause is another one that was on the headlines this morning, right? It's just, there haven't been companies that are addressing this until like the last few years, literally.
Yeah, happy to hear that as a daughter who's taking care of her elderly mom. Glad to hear you're looking deeper into those spaces. Brian, Capital Factory, I think you invest in, all sorts of industries, right? There doesn't sound like there's any really restriction in terms of what you look at.
Correct. We are sector agnostic, and we write small checks, so we don't ever, go too big in any one portfolio company. We are so diversified across so many different companies that allows us to participate in a wide variety of business, all the way to companies building the lunar economy and involved in the space economy, to companies in the healthcare space, building solutions with CRISPR and brain-computer interfaces, to prop tech companies with Krishna, so and B2B SaaS companies. So we are really across all of the kind of exciting sectors. Metaverse and Web3. We've got a very, very big portfolio, and that's really our unique strategy is to participate in most of the really exciting rounds. Certainly, a lot of the exciting rounds that are taking place with smaller checks, and be a part of building an incredible community and helping to power the community. We lean on lead investors. Like Sarah, like Krishna, to come in with their superpowers and do a lot of the hard underwriting, do a lot of the pricing, because with writing so many checks, a check or two a week, it's hard to do that. We can't take board seats. We can't sit and negotiate with founders. We actually don't negotiate. We see how how the underwriting will frequently get done and the terms will get priced, and we make a quick decision about, is this a company we want to participate in? And we frequently will say yes, given the reputation, of firms and individuals like Sarah and Krishna. We love to co-invest with both of their firms, and frequently find together we're better working on those startups. So it's been a lot of fun. We certainly, get very inspired by working with founders across kind of a wide variety of sectors, and to see how they're all different across, the different personas and the different geographies that exist right here in Texas. Of course, we see more space coming out of Houston. We see more fintech and the pipes and plumbing, the B2B SaaS and fintech occurring in Dallas, and more consumer tech than other places happening in Austin. Austin really has a lot going on, all the Web3, a lot of virtual reality related stuff. And so different cities have different strengths and different focuses. But we have garnered a pretty unique focus in what we call federal government and defense, or defense deep tech, given some of the partnerships that we have with the Army, with the Air Force, and a lot of the federal and defense organizations kind of landing and having offices inside a Capital Factory and being regularly present. We lean on our network a whole lot to find the signals and to help crowdsource a lot of the complex and the technical due diligence. And so, we will frequently see or introduce a founder that's in, that we're working with, or inside of our space, to an Army general or an executive at, an organization like McKesson or Blue Cross Blue Shield. And, when they get really excited and we see a deal or a proof of concept coming together, or successful results of a proof of concept, we will frequently be the first people to find out. And those are very positive signals for us. And so, we like to say that sometimes affords us not just the opportunity to see what lead VCs, how they're pricing the rounds, but really a complete view of the market, because we're seeing, living with these startups and seeing the interactions. And many times we're in the meetings with them and their potential customers, seeing how they react and being able to get some additional insights to how those companies, may go on and work together.
Yeah, it sounds like you are privy to some unique insights for sure. Krishna, I'm curious, if there's a startup that wants to pitch to Live Oak, how do they get in front of you? What's the best strategy? I know I've heard from different investors, they don't want to be DM'd on LinkedIn or Twitter, that they prefer email, or they prefer to be introduced by a mutual contact. But tell me about Live Oak. How do you all like to be pitched?
Marianne, we are, there is a well-chronicled blog, which I wrote last year, which chronicles this, it's called From a Cold Email to an IPO, a story of grit, perseverance, and some good old luck there. And of course, the story of Disco, which came into us as a cold email, right? And we've continued to be the lead investor through the whole life cycle of the business. And I became chairman of the board when we went public. And so, look, I would tell you on record here, we are as eager to meet compelling entrepreneurs as much as entrepreneurs are eager to meet us. It's the lifeline of our business, is to meet with good people. So we are delighted to people reach out to us in whatever form and fashion they want to. They can cold email us. They can obviously have somebody that they know in our network to drop an award for us. Anything goes. But look, it's just important to get in front of us. We also say no deal is too early. Again, that's the spirit of us, what we do locally here in this market. With that kind of a disciplined focus, we're able to talk to people early, give them feedback, give them what could be a goalpost when it makes sense for us to invest. And we just look for an extended period of interaction, helping them be successful, because the rising tide does indeed raise all boats in this market. That's very much the philosophy. So there are many companies where we have invested in them a second or third year from the first meeting that we had with them, because right at the beginning, they were a little too small, a little too early. We take the time to give them feedback, and we talk about how we work with people. When we've blogged about the Entrepreneur's Bill of Rights on our website, where we talk about the spirit of how we interact with folks. And we very much believe in that sort of interaction to work with folks and hopefully until they become an investment of ours.
That's super interesting. I'll have to look up the blog about the cold email. I have heard that from another investor who had a really positive outcome from a cold email. So yeah, that's really cool. IPO now. Sarah, how about you? How do you prefer to be pitched, or if someone's interested in talking to you, what's the best way?
My answer is actually pretty similar to Krishna's, is that we try to keep all the doors open. So of course, we'd love to have an intro from somebody we know that can kind of say, this is why it fits your fund. And that accelerates the review process for us. But we are proactively looking all the time. We're taking cold emails, we're taking, of course, we don't like the LinkedIn, so it's just harder to get it in our flow. So we do prefer an email if that's possible. But we also even have on our website a contact us form where it just kind of tries to clarify what we look for to make sure it's going to be a better chance of being a fit for our fund. But people can just literally submit their company through our website. So we really try to keep all the doors open, especially knowing that women have often not had the same historical networks in the venture capital community. So we don't want to close the door and require that it's a warm intro kind of deal. So
I love that. You're trying to make it as easy as possible for someone to reach out to you. Great. Brian, Capital Factory, how does that work? Do they apply or?
Yeah, mostly we have a pretty visible presence in the community. We hold a lot of events. It's how we probably meet the overwhelming majority of founders and startups that we decide to invest into. We collide with them in our space at one of our events. We're hosting founder investor happy hours constantly. We're hosting public events and just trying to get new people into the space who recently relocated to Austin. We hold public investment, what we call investment challenges, where we're intentional about investing in focus areas where we want to grow our portfolio, whether it's underrepresented founders, whether it's federal defense startups or healthcare startups, are themes that we'll publish for the year. But we love cold outreach. I respond to every single message on LinkedIn that I get, as long as it's not spam. And so when somebody has taken at least a minute to read my profile and understand that we're focused on Texas, if they're applying from somewhere else, I won't reply to things when people don't put effort into understanding how they will fit or how they will work with us. So I think that's among some of the best advice you'll ever hear from a VC or an investor is the quality communication. When somebody says, "Oh my gosh, Sarah, I love the thesis of True Wealth, and I saw that you made an investment in Dioro Medical Devices. We are solving a totally different problem, but since you invested in them, I thought you might want to also consider investing in us. I've attached my pitch deck. Do you think it would make sense to take a meeting?" That's a very thoughtful outreach. If you just immediately, if you don't take some sort of thoughtful approach, it is easy to be regarded as spam and not a fit. So be thoughtful with the quality of your communication and your outreach. Understand what the investor thesis is. These are all published usually on websites. They're very easy to find. Do not spam investors. Do not blast investors. Multiple investors on an email. That's usually doesn't bode well for a founder. Mm-hmm. And then a couple of other pieces of advice that I think are true for me, not just our Capital Factory, but usually the ecosystem. Network, show up, get involved in the ecosystem. There's so many events happening in Austin. The ecosystem is so dense. They're every day. They're happening all the time. You can find them. You can walk into Capital Factory and get connected with the other investors in the ecosystem. But that's not just that. Not just showing up. You got to stand out. And in reality, the first impression is your pitch deck. It's the quality of your communication. It's your pitch deck. So invest into building a badass pitch deck that is going to stand out and is going to impress the people that read it. And lastly, what I'll say is, remember that investors invest for outcomes, not activities. And so to be very clear about, Sarah, we're raising $2 million to get us from $1 million in ARR to $4 million in ARR by this particular date, really shows somebody you've got a real clear plan and helps an investor really identify whether or not it's a fit. That's my advice.
Lots of helpful advice. Some of that I would say applies to people pitching me as well. So thank you. So it looks like our time is almost up. I can't tell you how much I enjoyed this. It was great to see you again, those of you who I have met before. And this was just so much fun. So thank you all for being here. And thank you to those of you who tuned in.
Thank you.
Thank you.
Thanks.
Hey, thanks everyone for watching today. We have one more segment and it's going to be a lot of fun. This pitch off is great. We've done pitch offs in Austin for, I think our first one was 2012, and then we did another one in 2013 and 2016. So we're trying again. But first, I need to plug a couple things. This has been a special episode of TechCrunch Live, our weekly show hosted by myself, where we bring on founders and investors and talk about building better venture-backed businesses. But we're not live next week. Next week is our first in-person TechCrunch event in 2 years. It's hosted in San Francisco called TechCrunch Early Stage, and tickets are still available. This is a very special event because it's designed just for founders, and all the panels are how-tos, how to raise money, how to hire, and I'm hosting a panel on how to pitch and how to build a pitch deck. So I hope you can join us. It is in person and there's no virtual aspect of it. Then next week, we're going to have an investor from Andreessen Horowitz and Deal. And then the last episode of the month is with Okta and Front. So with that, let's start the pitch off. So we have the same guests that we had last time on Marianne's panel that are going to be our judges. And we're going to bring on Mark from Fabulinga to give us our first pitch. And while he's coming online, let me tell you how this is going to work. The companies are going to have 4 minutes to present with the slide deck, and then the judges will ask the questions for 5 minutes. Mark, you there?
I am here, yeah.
Great. Well, it's the clock is yours. You have 4 minutes starting now. Good luck.
Okay, great. Hi, everybody. I'm Mark Beggart. I'm the CEO and co-founder of Fabulingua. I started in finance. I've been in tech the last 20 years. I helped found and grow a mobile interactive entertainment company in China from startup to NASDAQ IPO as a CFO. Always loved languages, though I've struggled with them. I did marry a polyglot, and Fabulingua is a result of our personal experience solving for an engaging, effective solution for our young kids. Slide. The convergence of education and gaming will engage learners and transform teaching models. We know gaming is now replacing traditional media for kids, and engagement has been a critical missing piece in education. Gaming's not passive, it's interactive, challenging, creates community, and requires learning to develop mastery. Slide. There are 2 billion people in the world learning a new language, and the market will double by 2025 as it moves from offline to digital. Now, we hear a lot about the adult market, but the kids market is arguably larger. Slide. Yet, kids language teachers are using old content and curriculum. They're frustrated, they're paying out of their own pocket for resources, many are quitting, they don't have the right tools to succeed. Slide. We're addressing an escaping need. Fabulingua is a first of its time subscription-based mobile game where kids play to learn, focused on kids. It's centered around our story-based learning IP we developed in-house and awaiting a patent. We initially focused on the consumer, but teachers are pulling the product from us. So we're now empowering language teachers and tutors, which leads to parent monetization. If you're familiar with Prodigy, Math Game, or Epic Kids reading platform, the teacher-led adoption parent monetization model has led to 9-figure revenue and outcomes. And now we'll be doing this for a large untapped global market with Fabulingua and language learning. Slide. Our learning innovation is that kids can play an engaging mobile game where they're rewarded for reading and interacting with narrated stories in a new language. It's immersive, natural language learning. Slide. Our learning IP uses natural language through stories and elements of simultaneous translation. Kids are immersed and enjoying the story or game in a different language that is made comprehensible. It's how we learn our native language from birth. It's invisible learning, and it's the sweet spot of language learning science, especially for young brains. Slide. We launched our MVP with 3 stories, and we've made some strong early progress. As I mentioned, teachers are pulling the product from us and signaling the opportunity to serve them. So we created a waiting list campaign for our teacher module and quickly had 700 teachers sign up for around $6 per teacher. Slide. So with the teachers' help, we're building a teacher platform that will seamlessly pair with our mobile game and app. Teachers are highly credible product ambassadors. We're going to incentivize them to share lessons, activities, connect them with the teacher community, and facilitate outside tutoring. Slide. Teachers are a unique distribution advantage with compelling unit economics and network effects. They have more autonomy than ever before to choose and adopt the digital tools that are right for them. And they reach hundreds of new students and families each year, and they share with one another. Slide. Over the next 5 years, we will expand our platform and scale into more language markets. To hit $1 million ARR, we need to get to 500 teachers and sign up 10,000 family subscribers. By the end of year 3, we'll have expanded into Asia. By the end of year 5, we'll be in 10+ languages and on our way to $50 million in ARR. Slide. I told you about me. My co-founder is the brains behind Fabulingua's learning method. She studied children's linguistics and literacy at Oxford. She developed a skill set in simultaneous translation and drives our teacher relationships. Joseph has been in mobile gaming for the last decade, most recently with App11 and Jam City as digital director. Thanks. Any questions?
Thank you very much, Mark. And I need to mention that the judges are going to look at these companies and evaluate based on potential for impact, both socially and financially. With that, Krishna, let's start with you.
Talk about what kind of outcomes you've seen to date, Mark. Can you talk about how do you know this thing works to date?
Yeah, well, so there's a few reasons why we know that it's effective or why it's working. One, the teacher adoption has been off the charts. So they've identified the value in our learning method. Our learning method is based on language learning science. And in fact, we've won 2 linguistic awards for best new technology by a panel of language learning experts. So a whole method of comprehensible input And the ability to sort of lower the affective filter is a part of language learning science of the last couple of decades, but has not been effectively incorporated into language learning tools, particularly those that are sort of anachronistic.
Sarah?
Yeah, I'm interested in your go-to-market. Sounds like obviously your end customer is the student, but you're looking to teachers to pull it through to the parents, charging them $6. I think you said at some point a teacher. What's the actual? Who's the actual sort of purchaser long-term?
The long-term purchaser would be yes, the parent, the family. So the way that the model works, as is by sort of Prodigy Math and Epic Kids, both have had tremendous outcomes with this model, is essentially the teacher adopts a freemium platform, and that free platform allows them to use the tool in class. Then the kids are given sort of limited access outside of class. But because it's a game and because there's engaging content associated with it, they're interested in using it more outside of class, which of course incentivizes parents to see that there's an opportunity to continue the learning, at which point they pay for either a monthly or annual subscription, get unlimited access to the content and the gameplay.
Mm-hmm.
Ryan?
Yeah, a couple of questions related to your user base downloads. Where's the delta going between the 102,000 downloads and the 21,000 registered users? There's kind of 80,000 people that didn't kind of get fully logged in and create accounts. That seems like pretty low hanging fruit. How do you close that gap? And then lastly, of your registered active users, are they, can you break that down between daily, weekly, monthly, and what do you measure the most between that?
Yeah, so the user base is associated with the MVP that we launched in 2020. Started out with 3 stories, and we added each new story sort of every month or so. And frankly, what we were really trying to evaluate was what kind of engagement we were getting with the kids with the stories. And what we learned was that our particular method with regards to reward system, incentive and intrinsic rewards, and getting the kids through the different modes of the story needed to be optimized. And that's when, about middle of last year, we leaned heavily into mobile game design. So now we've created essentially a mobile game loop where a kid would read the story or do the associated activities. They earn keys. Those keys unlock chests. In order to win the chest, they've got to do certain other activities. So this keeps the kid engaged and incentivized to come back. And of course, what we do is we continue to expand the sort of fabulingual world as it's based upon the child's ability to sort of become more and more proficient in that particular language. So it's really, Brian, our focus based upon what we saw in the MVP to get more engagement and daily sort of retention and activity out of these kids. And games and gaming is a really effective way to do so.
So Mark, I want to pick up on Sarah's question there. From a go-to-market motion side, right? Teachers themselves might not have individual budgets. Schools and school districts do, and then it's kids who use it. And the upfront sale process to a teacher has proven to be difficult because they don't have budgets individually. Number 2 is that link between teacher to a student to ultimately convincing parents to buy off has been a challenge because these kids might not exactly articulate to their parents how I desperately want to keep learning, might be a challenge. So have you all, how do you think about that sales motion versus going to school districts instead and trying to get that thing primed the pump at the school district?
I'm not really interested in going to school districts. I know that that's a long sales cycle, and that's why we're looking at it as sort of, it's similar to the sort of new SaaS go-to-market model. It's sort of a bubble up sort of effect where the teachers adopt this free platform and they get engaged and are using this tool. And so therefore, their sort of enthusiasm for the tool might mean that at some point they purchase sort of the premium module. But if they don't, what we're really focused in is on the game, which means the engagement associated with the game is what the kids are going to want to continue to do again and again. Prodigy Math Game is a perfect example. It's essentially an MMO game, and kids do math in order to advance. We're doing the same thing with language learning. That's a company that's now just raised $125 million on a $1 billion valuation from TPG Capital. So, and similarly, you had a company like Epic Kids, which just got acquired for $500 million by Baijiu, with the same type of model. It's this teacher-led model that ultimately the parents monetize, but you got to have a good product and you got to be engaging the kids.
Mark, thank you so much. That was a great answer, and we're going to have to leave it there. But one more time before we go, what's the website that people can find you at?
You can find us at fabulingua.com, and it's FABULINGUA.com, fabulingua.com.
Great. Thank you very much. Best of luck.
Appreciate it.
Oh, that's great. Well, we have two more companies. Next up, we have David. David's from KnowRx Health, and for language learning, that's something I need. I have trouble even with English itself, let alone anything else. All right, David, are you on the line?
Yes, I am. Thank you.
Great. Well, you have 4 minutes starting now.
Good day. I'm David Franklin, the founder and partner and CEO of KnowRx Health. We address inequality in clinical research. There are many avenues to solve these problems, but here are two important items that we are addressing: the quality of drugs being manufactured and the costs associated to the public in purchasing these medications. This is important because in 2018, I lost my father due to medication complications while he was being treated in the ICU. Secondly, being a father of a multiracial family, African American and Hispanic Latino, my children will directly be impacted on new drugs being formulated. I couldn't help my father, but we can help everyone else moving forward today. Clinical research takes a lot of time, 10 to 15 years to receive FDA approval, and the cost continues to increase. Today, the lack of information, recruitment, delays, and the misalignment of study locations are directly tied to barriers to success. Next slide. As a result, the process produces nearly 80% of trial data insufficient for safe use and effectiveness in non-white patients. We don't think that's fair. Do you? Next slide. Patients are ready and they want to change. 76% of them want to participate, but the message doesn't arrive from a trusted resource. Next slide. The KnowRx solution provides smart, inclusive health research. Simply put, we connect to sponsors, collaborate with trusted providers, physicians, care teams, and build a diverse community of patients across therapeutic areas for research. Next slide. Our impact, KnowRx, therefore increases diversity and participation, reduce costs through development that results in better data and better drugs. Next slide. Again, I am David Franklin, U.S. Navy Gulf War veteran, founding partner of KnowRx Health, and we are strongly positioned to lead these efforts. My co-founder, a physician, the executive team, and advisors have over 50 years experience in clinical research in the advancement of health diversities. Next slide. The addressable market is large, but our concentrated efforts are driven by client engagements and focus within the African American and Hispanic Latino communities first. Next. We embrace competition and have identified advantages in physician engagement, drug analysis, in real-time patient feedback, and accountability services. Next slide. We have two revenue streams, a monthly subscription model for data analysis and a yearly subscription that educates, engages, empowers both the physician and patient for clinical research. Next slide. In closing, we have secured client recurring revenue with Johnson & Johnson in collaboration with the Cobb Institute, completed a paid pilot for the COVID-19 vaccine, and continue to build our pipeline through growth. Since 2019, we have completed 3 accelerators, 2 pilots, and have grown our physician database and network to over 900,000. Next. Again, I am David Franklin with KnowRx Health, and I welcome your feedback today. Thank you.
Very good, David. Thank you so much. Sarah, let's start with you, please.
Sure. I'd love to get more clarity on what it is you actually do or what you're selling. I understand, how non-inclusive clinical studies and research have been to date, but you had a slide of smart inclusive research is you're offering, but I don't know who that is or what your customers are. And if they're like pharma companies buying this research, they have such strict guidelines in terms of, what they need for clinical trials to be able to use that data. So if you could clarify that.
Yeah, is stated. So we sell to pharmaceutical companies. Our clients are Johnson & Johnson that we currently have today. On the one slide that said smart inclusive health research is our solution offering. So what we do here is we connect sponsors, pharmaceutical bio companies, to physicians and collaborate with these physicians in helping navigate information to them based off the patient population who wants to participate, and then extend that information down to the patient for the opportunity to participate in clinical research. We have two products. We have EpCare, which is the physician engagement side, and then we have the ALAP, which is the patient engagement side. Combined together, we have a solution that's very attractive to the pharmaceutical companies.
I have some more questions, but I'll give you two.
Go ahead, Sarah. Ask a follow-up, please.
So then I guess what are they paying for? Like the physicians or those patients? What do they pay? Or I guess J&J pays, but then
yeah, the sponsor pays. The sponsor pays. The sponsor is our only client that have communicated. That's who buys our services, whether it's a data subscription or a full service subscription. In the first full service model, so in our current contract, it's $1 million. Our first contract's over $1 million with the sponsor. It's for physician recruitment, physician navigation, and new site locations, which in result drive potentially new patients to participation.
Thank you, Brian.
Yeah, so your patient acquisition model is really through physicians. So you get physicians on board, and every time, I'm just confirm if this is correct. Every time, if I'm a physician and I see somebody a patient come through with a particular set of issues or demographics or whatever it may be, and they're identified as a candidate for a particular clinical trial, then the physician is enlisting and enrolling or recommending that patient get involved. And so you're relying on the physicians to onboard you, identify and onboard users. Is that correct?
Yeah, you're very close to that timeline there of transactional events. So a couple things happen first. We educate the physician. Not every physician will become an investigator or will become an investigator for a new site location. They all have the availability to communicate information relative to clinical research based off that protocol. And this sort of goes back to what Sarah was saying, that there are protocol IRB approval prerequisites for participation. So based off our machine learning algorithms, we receive the information, the protocols from the sponsor side. When a physician identifies, and here's a medical term, ICD-10 code around this physician, say like in this case, we're doing inflammatory bowel disease, then that information will be provided as a pass-through through the physician down to that patient through our mobile application. So we don't take the time away from the physician. We educate the physician, but it's a pass-through from that physician down to the patient.
Do you foresee a path to acquire that end patient without the physician?
Well, primarily it should come through the physician as the trusted resource, the trusted provider, but we do go and market directly to patients as well to grow. As I mentioned, we have over 900,000 physicians in our network. So that's a patient acquisition model right there, but we do communicate directly to the patient and through community advocacy groups as well.
David, do you have any data around either physician selection or the patient vetting that is superior to other methods? It's a very common technique to go through your primary care doctor to go find patients. Why do you believe this is any superior? Did you give data to support it?
Yeah, it's not very common at all. And it's not readily used within the CRO space. They use more traditional methods. The primary care team or physician is often overlooked, and the majority of physicians are not. They don't understand the value of helping the patient understand this. So this is really a novel approach, is actually going through the physician for this aspect in this regard.
Well, thank you very much, David. That was really interesting. We're going to have to cut it there. That was our time. Thank you very much and best of luck. All right. We have one more to go today. We have Charlie from Vertical X Inc. Charlie, are you there? Well, he comes on in a second here. So once again, everyone, this has been an extended episode in Austin, and I'm truly jealous of Austin because I'm freezing in Michigan right now. I had a sweatshirt on before we did this panel, and it needs to go back on. Charlie, are you there?
Here.
All right, great.
Howdy.
Hi there. I like the hat. Very nice. Well, you have 4 minutes to present Vertical X.
Next slide. Howdy, I'm Jose Carlos Charlie Sarmiento, a future athlete since the age of 5 years old. I got a partial scholarship when I was young in a USA university, but couldn't make it because of lack of resources after my dad passed away exactly today, 26 years ago. But here I am standing up again to solve the problem I face and help young athletes to monetize their trainings and overcome the obstacle of the scarcity of resources and make their parents' life easier. This is why I created, next slide. This is why I created Vertical X, the NASDAQ for athletes, where we want to empower athletes to become sports entrepreneurs, own their data, and choose to raise equity and fund their sports career and higher education through training. Next. So that's our value proposition that we want to create for these young athletes. Next. We have been bootstrapping since March 2020 in Guatemala, where we develop our Magic, a process where we scan and collect athletes' data to develop a composite training performance index, integrating the results from scanning the brain, body, and sports performance assessment. Next. In business language, it's like a VC of athletes by athletes. Where our Magic will license to third parties training facilities to collect the data, develop their profiles, build their TPIs or training performance indexes, issue tokens in different tranches, high school tranche, college tranche, and pro tranche, and list them to start raising equity and training hard and trading their tokens. Next. So using high technology such as blockchain to be reliable, transparent, and scalable for all the stakeholders involved. Next. This is how our prototype looks like, and after raising, we will be able to start the MVP and beta process in US. Next. So, structuring a sustainable and robust business model with 3 revenue streams, allowing millions of athletes to build a strong sports career and become savvy entrepreneurs is what we are doing here. Next. So we develop a solid and lean entrance strategy in the US market, particularly in Austin, Texas, considering Texas is the #1 state in the United States with the highest number of high school and college athletes all over the United States, and convert the American dream a reality. Next. We want to revolutionize the sports industry with a unique proposal, and we are ready to overcome any obstacles needed to make it happen. Next. So through a very disruptive team, highly talented and passionate about sports and desiring to impact humans' lives through sports. Next. Generating economic value to our shareholders for the long run. Next. Which is a tough race, as we did in 2021 during COVID in our sports lab in Guatemala, and took us here to this present moment. Next. We are able to work hard for the short, small wins and empower millions of future athletes in the US, and why not all over the world. Next. For something always greater than ourselves, this is Vertical X. Thank you very much.
Charlie, that was good. I really enjoyed your passion. Thank you. Krishna, let's start with you again.
There we go again. I'm trying to understand, what is the point of tokenization? Is there a viable business here on a standalone basis without the tokenization, or is that a must-have and a part of what makes this business work?
So what it makes it work, and it's a standalone business, because you will be able to create.
No, I'm saying without the tokenization, is there value in what you do without the tokenization? Is tokenization required to deliver on the value? Is tokenization required for Vertical X to be a viable business? Is what I'm trying to understand.
No, tokenization is because the value that will be attached to the trainings of the athletes, you will be able to value that in the market, and it will have a volatility based on their improvement of performance, and that training performance index, when it goes up or down, it will have an intrinsic value in the market, and it will be the base for each tranches when you issue your tokens as an athlete. So this is like when you are raising capital for a company. So you are doing it in different tranches. So each tranche will have a market price base and link it with that performance that you have had in your training performance index.
And why does that ultimately benefit with placement of athletes here? Why is this tokenization going to impact it, as opposed to the traditional mechanism in which athletes get feedback from coaches, and that's just natural base for them to be discovered?
Because the value here is that these athletes can raise money to fund their sports career, right? Because it's only 2.5% of sports scholarship available for more than 8 million athletes, high school and college in the United States. So it's a very huge gap, so they can fund their sports careers. So how you do that, the way you do it is you create a value based on this index. That value is also linked, and the token is linked with the future earnings that they could have as a pro athletes if they, after going through these stages or tranches, they can get. It's like a company when it's a seed company. There is a valuation, and then
So the point is, you believe fundamentally that the natural market discovery of these athletes is flawed, and you think there is going to be value discovered, and the crowd betting on crowd tokenization is going to be unlocking a value. That's the fundamental hypothesis here.
Yes.
That was a good summary. Thank you. That helped. Brian, let's go to you.
So I'm trying to understand what success ultimately looks like for an athlete that gets on the platform. Is success, does that mean that they earn money through the value of tokens and they're funding their college scholarships? Is it that they get discovered and they go pro? Is it that, or is it that they find a different career path through this platform? What is, as the athlete journey through this platform, what's the holy grail? What does success look like in this platform for the athlete?
So for that, the first success is funding their sports career. That's going to be their first success. So they don't have to have 5 jobs in a Starbucks or any other, and they focus on its training. That's the first success. So they will raise some money for that. And secondly, this data will be able to do a predictability of the success of a future pro athlete. So we can project that for recruiting, but the main success is raising money.
And if somebody gets invested in the platform and they have some progress, and then they get discovered and somebody sponsors them, and they get so busy that they can't invest in this platform anymore. They don't ever log in because they got discovered by some awesome coach or awesome sponsorship. How do you follow the success of that athlete and follow the monetization of that athlete once that's leaked outside of the platform?
No, so basically, exactly. So basically, when we profile the athlete, those rights of the athlete are in those tokens. So he basically put that his know-how in that company, and those rights are the ones that he's issuing with these shares. So that will be, for example, if I invest in an athlete, let's say Michael Jordan, I invest him in when he was 17 years old, and right now, he, those tokens should be getting value today, and you can exit from those as an investor in the market for those stocks or tokens.
All right. Well, that ends our time today. So thank you very much, Charlie. That was really interesting. I wish I could invest in Michael Jordan. Well, thank you for everyone for watching, but we need to announce a winner. So what we're going to do with that is the judges and I are going to talk backstage of sorts. And then the winner will be announced on TechCrunch.com, I would say within 30 minutes, I will have that ready to go. So look for that. We'll also tweet it out. And once again, thanks for joining us. We hope you can join us at Early Stage next week in San Francisco. And then we'll be right back here the following week with Andreessen Horowitz. So we'll see you soon. Thank you.